rising interest rates affect VCs, startups, and funding opportunities. Hello people, I am Suraj Deo and welcome back to Deo Talks, your very own community for all things health and finance. Today let's talk about how rising interest rates affect startups, venture capitalists and funding opportunities for startups. Let's break this topic into three parts to make it easier to understand. Part 1. How does the venture capital or VC ecosystem work? Part 2. Quick context of interest rates. And then part 3. Impact of rising interest rates on startups, VCs and funding. Alright, let's begin. Part 1. How does the venture capital or VC ecosystem work? In the world of venture capital, a team of people called general partners creates a VC fund. These general partners or GPs are like fund managers and they usually have a background in finance, entrepreneurship or technology. The GPs raise money for the fund from various big investors called limited partners or LPs. But who are these LPs? Well, they are institutional investors, for example, pension funds, insurance companies and university endowments. University endowments simply mean donations or money received and set aside by some prestigious institutions like Harvard, Yale, Stanford and some IITs from India. They are the ones who invest a lot of money. Apart from them, there are also super rich individuals like Jeff Bezos and Elon Musk and some family offices who also become LPs and participate in VC funds. So the LPs or limited partners commit a certain amount of money to the fund. And the GPs use these funds to invest in various promising startups. For example, a VC firm might create a $100 million fund and raise money from various sources such as wealthy individuals, pension funds, etc. The VC then selects a group of promising startups to invest this money. So in simple words, startup founders go to VCs for funds and VCs go to LPs for funds. The goal of the VCs is to generate returns for the LPs through successful exits, such as an initial public offering or IPO, a merger or acquisition, or a secondary sale of the investment. The returns are then distributed to the LPs in proportion to their capital commitments to the fund. Of course, after deducting any fees and expenses charged by the GPs. Part 2. Quick context of interest rates. Now let's quickly understand the context of interest rates here. As we all know, central banks across the world have a number of tools at their disposal to manage inflation and maintain economic stability. And one of those tools is adjusting interest rates. When a central bank raises interest rates, it makes borrowing money more expensive for businesses and consumers. This means that people and companies are less likely to take out loans because they will have to pay more interest on the money they borrow. By doing so, central banks hope to reduce inflation. However, if interest rates are increased too much and too quickly, it can lead to a recession or economic slowdown, as higher borrowing costs can cause businesses to cut back on investments and consumers to cut back on spending. One small request before we move further. If you have found this information useful so far, please like this video and subscribe to our community. Your support means a lot. Part 3. Impact of rising interest rates on startups, VCs and funding. Now moving to the final segment of this topic. How does the increase in interest rates affect VCs and startup funding? Let's discuss this point by point. Number 1. The shift in investment focus from early stage to established companies. When interest rates rise, investors like venture capitalists or VCs prefer established companies with a proven track record of revenue and profitability. They want to be sure that they will get their money back. So startups that are just starting out or early stage startups may find it harder to get funding, as VCs prioritize more successful companies in this case. Number 2. Investor risk aversion. From high risk to safer options. Risk aversion simply means playing safe with your money. When interest rates are low, investors are more willing to take chances on higher risk investments, such as startups. However, when interest rates rise, investors may become more risk averse and prefer safer investment options with guaranteed returns like bonds and other fixed income securities. As a result, startup companies face increased competition for funding, as they need to compete with these safer investment options to attract potential investors. Number 3. Lower valuation. Rising interest rates can impact how investors value startups. A key factor in valuing a startup company is its potential for future growth and profitability. When interest rates increase, it can raise the discount rate used to calculate the present value of a startup's future cash flows. A higher discount rate means that the future cash flows are less valuable today, potentially leading to a lower valuation for the company. This can make it more challenging for the startup to negotiate favorable terms with investors during fundraising rounds, as investors might be more cautious about the company's future growth prospects. Number 4. Longer time to exit. Startups usually aim to be acquired by larger companies or go public through an IPO in order to provide returns to their investors. But when interest rates are high, potential buyers or public market investors may not be willing to pay a premium for the startup company. This reluctance to pay a premium could make it harder for startups to find an exit at a desirable valuation. As a result, it may take longer for investors to see a return on their investment. Number 5. Impact on consumer spending. Rising interest rates can also influence consumer behavior. When borrowing costs are higher, consumers tend to be more cautious with their spending, especially on non-essential items. This decrease in consumer spending can have a direct impact on startups that rely on consumer demand for their products or services. It may result in reduced revenue growth and profitability, making it more difficult for startups to attract investment. Number 6. Sector-specific impacts. Certain industries are more sensitive to rising interest rates, particularly those that rely heavily on debt financing. For example, startups in the real estate sector often depend on loans to finance property purchases. When interest rates rise, the cost of borrowing increases, making it more challenging for the potential buyers to afford home loans. This reduces demand for properties and impacts the growth and viability of real estate related startups. Similarly, other industries that rely heavily on debt to fund their operations may also face challenges in accessing affordable capital during periods of rising interest rates. Number 7. Economic downturn or recession. Significant and rapid increase in interest rates can potentially lead to an economic downturn or recession. During such periods, investors become more cautious and risk-averse, making it extremely challenging for startups to secure funding. So the overall economic climate plays a crucial role in the availability of capital for startups. Now it's time to conclude today's topic. So in summary, rising interest rates can make it harder for startups to get funding and achieve their goals. Investors become more cautious, borrowing money becomes more expensive, and startups face increased competition for limited funding. So it's important for these companies to adapt and find alternative ways to finance their growth during times of rising interest rates. That's all for now, and please feel free to leave any questions or comments below. Thanks a lot for your time, and let's take care of this beautiful world. I'll see you next. And smile. Always smile. If you want more such insights, please watch my previous video to understand the basics of interest rates and its impact on you, me, and the economy.